Hey everybody, I hope you're doing well today. Today we're going to take a look at international barriers to development, and this is part of the International Trade and Economic Development series. And we're going to take a look at what sorts of things can get in the way of developing nations trading with other countries. So here we go. There are three main barriers. The first one is overspecialization. I should say overspecialization on a narrow range of products, price volatility of primary products, and inability to access international markets. You might see how there's actually quite a connection here. Overspecialization on a narrow range of products. This tends to be in developing nations, a reliance on primary products, right? And then the price volatility of those products, of course, leads to problems in terms of development and stability in the marketplace. And just the sheer size or lack thereof of developing nations sometimes it prohibits from being able to access the international markets. But let's take a look at them more specifically, and starting off really with over specialization. What does that mean? Well, while the share of manufactured goods produced by developing countries as a percentage of the world trade is growing, a number of developing countries are dependent, this is critical to understand, on primary commodities for a significant share of their export revenues. So these are things they export, right? This is because it's trade. So rising commodity prices may therefore be beneficial to those countries at times. However, if the prices fall, then the economies experience deteriorating ability to fund programs that they had already planned on financing, like education, health, and infrastructure. And the problem is that if there's a lot of validity, a lot of if the international markets are super volatile and there's big swings in the prices of a very narrow range of products that this country can produce, like, for example, primary products, then all of a sudden they can have government programs that they funded when the price of the commodity was high, but then they find it very difficult to finance it afterward. So countries, so unless they can change the pattern of their exports, these countries are dependent on a narrow range of primary exports to find and will find it difficult to gain much growth through international trade. Remember, instability in the marketplace is super bad for development, all right? But regardless of the types of goods that are exported, be they commodities, manufactured goods, or even services like tourism, if a country is dependent on too narrow of a thing, exports, they face great vulnerability and uncertainty. And an example would be like, say, the Dominican Republic. You know, they have developed like sugar and coffee industries, but really tourism is number one. And if there's a downturn like there was in 2008 in the United States in terms of the economic the economic well-being of people from the United States or Europe, then they're going to be in trouble when it comes to supporting the kinds of programs that they want because they're too focused on one particular export and, like, for example, tourism. Okay, the other thing, and this of course goes along with it, and I've kind of mentioned some of this, but like price volatility of primary products, and this goes back to the elasticity of primary products, in that they're very, very elastic, right? So if if there's volatility in the world market of both the supply and the demand, any sort of slight change will have a massive impact on their ability to be economically strong, economic growth, right? So these sorts of volatilities, price volatility on primary products, will have a marked impact on the export revenue of the countries that are selling these commodities. And this instability and subsequent export revenue volatility make it difficult for producers and governments in developing countries to plan ahead. That's a problem because you need to be able to plan ahead in order to invest in countries, and companies need to plan ahead in order to make decisions about where they're going to invest their money. And therefore, this can hurt growth, which hurts education, healthcare, infrastructure, and then in the end, of course, right, development. Okay, and the last barrier to barrier to development is the inability to access international markets. And what this means is protectionism, as you remember, is any economic policy that is aimed at supporting domestic producers at the expense of foreign producers, right? We've seen this, such as tariffs, subsidies, quotas, in our earlier studies. But protectionist measures by developed countries against the exports of developing countries can be super harmful. So these are those who have the developed that are protectionist against the developing nation. If the measures prevent developing countries from utilizing their comparative advantage and exporting to developed countries, then developing countries will be limited to their ability of foreign exchange. And the ability to have foreign currency is critical to many small developing nations because, number one, they may need that money in order to buy products that are sold in that currency. Dollars is a great example. If you want to buy dollars, if you want to buy oil in the world market, you have to have dollars. Well, how are countries that don't have a convertible currency, for example, how are they going to get dollars? Well, one of the ways that they get dollars, of course, is to sell their goods. But if they can't sell their goods, how are they going to be able to get the dollars they need in order to continue to develop? Right? So protectionism in any market is damaging for developing countries, but it's especially in the case of primary markets because for the reasons I just explained. Okay? The other problem that's sort of embedded in this, if a developed nation like the United States puts up a protective tariff against, say, production of rice or dairy products or something, that then there will be overproduced in the developed nation, right? Subsidies create an overproduction beyond what the market would normally bear, and then there could be a surplus in the developed nation, and then they could dump it, quote unquote, into foreign markets, and that in the developing countries, it's very difficult for small scale farmers to participate in or to survive in the marketplace because the dumping of this primary product will naturally be below the market rate in which the local producers can produce it. That was a little convoluted, but dumping is the notion that foreign countries are adding excess subsidized basically commodities to the world market, and that puts local farmers in developing nations out of business. Okay, so there you have it. A brief overview. There are more details and more specific examples that you could find in your course companion for each one of these. But there you have an international barriers to development, the overspecialization on a narrow range of products, price volatility of primary products, and then the inability to access international markets for developing nations. I hope you found this video to be helpful, and we'll talk to you in a bit.